Okay, so we are still trying to identify or convert our book income to our taxable income. We've already taken the step of finding our permanent differences and adjusting our book income for those net permanent differences that we arrived at above here. And now we've got to figure out what our temporary differences are. So what are our amounts this year that are gonna add to or reduce taxable income, but then are also going to reverse in the future years? There are four different kinds of temporary differences, four different situations. Um, Revenues that are taxable after they're recognized in the books for book purposes. Um, these are items that are income first on the books and then get taxed later. Expenses that are deductible after they're recognized on the books. So stuff is expensed first and then it's deducted in some later period. Okay, both of these are. Let's see. Both of these. Let's see. No, I'm not going to say that yet. The third thing is revenues or gains that are taxable before they're recognized in the books, and these are expenses or losses that are deducted after. I'm sorry, before they're recognized in the books. All right. So here's a bunch of common temporary differences, and now we have to understand what determines a taxable temporary difference and a deductible temporary difference. We've said in the prior chapter that if a timing difference reduces our current taxable income, it's said to be favorable. Okay, it's said to be favorable. But what does that mean for future purposes? If it's favorable this year, that means it's going to be unfavorable in a future period. And we call those taxable temporary differences. So it's a little bit weird to think about, but favorable differences this year are taxable in the future. All right, so you have to kind of connect those in your head. Deductible temporary differences are amounts that were unfavorable this year, but they will, so they added to taxable income this year, but they will reduce taxable income in the future. So they're said to be deductible temporary differences. So unfavorable temporary differences this year give rise to deductible temporary differences in the future. So back to our example, we look at our taxable temporary differences from our example. That is things that were deductible this year, deductible differences this year, or favorable differences this year, and will reverse unfavorably or taxably, if that's a word, in the future. So we had two. We had let's see, depreciation. We had an excess tax over book depreciation amount of $700,000, and then we're offsetting this gain on the asset sale, this $16,000 difference. We're putting this up here too, because this really related to those same assets being depreciated. So we consider those two taxable temporary differences of 684. Those will reduce our current year taxable income because they're favorable this year, but they will cause taxable amounts in the future. And then we also look at the rest of our timing differences, our temporary differences this year, that will add to our tax liability this year, but will reduce our future tax liability. So these are deductible temporary differences. They add to this year's tax liability, but they will reduce future tax liabilities. So again, we're still calculating the current tax expense. So the 684 is reducing our current taxable income. And the 167 is adding to our current taxable income. And these are all temporary differences. So the net combination of those two is this 516.3. This is a net reduction to current year taxable income relating to temporary differences. So to calculate our current expense or benefit, we will take our pre-tax book income and we subtract these favorable permanent and temporary differences to get taxable income, multiply by tax rate, and get our federal income tax payable. And then we book the journal entry to record that expense. Debit the expense, credit payable, because it's an expense. It's not a benefit. We're going to pay tax this year.